thanks for inviting me, and thanks for this conference. There is, kind of the beginning of it, and Emma talked about this, was the amnesia. Unfortunately, we think of it at Better Markets as a created and purchased amnesia, not actually clinical amnesia. But if you know anybody who's getting amnesia or you're having amnesia, I don't have a book, but I didn't write a book, but I have a book. You've got to read Crashed by Adam Tooze. It will remind you in laborious detail of what happened and some very novel and good theories about why it happened. Because what's remarkable is when you read about what he talks about is happening and being said in the 1990s and the early 2000s, the exact same things are being said today. The exact same things are being done today for the exact same bogus reasons. I could quote my friend Ed Kane and say, for the same bullshit reasons, but I won't. So Better Markets is an advocacy group. We've participated in, I was Jesse, a defense lawyer at Skadden Arps for about 20 years, participating in many of the things that he talks about, in a very different era, though, pre-crash, pre-Enron, pre-Arthur Andersen. And then I spent 8 years in the United States Senate. We founded Better Markets in 2010 after the Dodd-Frank law was passed, because we realized there was no organization that was professional to be a counterweight to the industry. Because when you talk about there can't be agreement on what predation is, it's because the predators are at the table helping define that their conduct is not predation. And so you alluded to it very quickly, but it was a very important comment about how somebody got together with the trade groups to define how they're making their money and their profits. So since 2010, we've participated in over 200 rulemakings and about 30 litigations. And in those 250 rulemakings or so, about 70% of them, we're the only non-industry participant. When you get into derivatives and the complicated issues, over 90% of the time we're the only non-industry participant. Who's writing these rules and for what purpose? So I've been asked to talk about hiding risk. So you want to talk about hiding risk. There's a massive deregulation going on, not 10 years, as was alluded to earlier, not 10 years after the crash. And there's been some studies that say usually it takes 20 years. I was with Ken Rogoff from Harvard recently, who made the comment that this is, and Ken knows, I mean, he's only looked over 800 years or something, I forget what it is, that crashes. He said this is the fastest in history between a major crash and the time at which the rules that were supposed to prevent the next crash were already being taken down before they were implemented. That's the other thing, over half the rules aren't even implemented. I mean, it's just shocking how fast this has happened. It's not shocking if you think about the money that's at stake, though. So hiding risk is really the flip side of bonuses, right? Profits and bonuses on the other side of hiding risk. So why do I say that? Well, later on you're going to hear a panel about innovation with some of my good friends on it, Gary and some others. Innovation, in my view, is one of the primary words and tools for hiding risk, because nobody wants to be against innovation. Innovation, what's better than innovation? Nothing. But I'd submit that innovation in finance is very different than innovation elsewhere, and red flags should always go up when you hear them. Most financial innovation turns out to be another way to separate you from your money. Often it's just another way to get somebody else to take the risk of the innovation they don't want. I'm not going to go into this much. I don't know if they're going to talk about it later, but credit default swaps is a wonderful innovation. CDOs, collateralized debt obligations, Jesse alluded to Magnetar, and synthetic CDOs, by the way, because we couldn't milk enough money by ripping people off with CDOs, so we created a synthetic CDO. It's just astonishing when you go through and you look at the product, the innovations in finance. Paul, my good friend Paul Volcker, who was talked about earlier today, has a line widely quoted, usually meaning to dismiss him, where he said, the only financial innovation in the last 20 years I can think of is the ATM. And all the smart guys in the suits on Wall Street go, oh, that guy, old guy, doesn't know what he's talking about. If he's wrong, he's not wrong by much. There may be another innovation besides the ATM that makes sense, but most of the innovations are meant to hide risk and shift risk. And when you hear innovation, a red flag should go up. Hiding risk happens in a lot of places. There's three primary arenas that you should look on, only one of which gets any attention. There's the legislative, regulatory, and judicial arenas. The legislative arena gets all the attention because it's this big clash between Republicans and Democrats, and you get to see it, and the cameras love following it around. You know, some hiding risk happens there. The recently passed deregulation bill 2155 that was signed earlier this year deregulated a whole bunch of things. Importantly, banks, poor little banks, between $100 billion and $250 billion in assets. You know, your little neighborhood bank. Everybody here who's hanging out with somebody with $250 billion, raise your hand. So that bill was focused on, when you look at asset size, there are 5,800 banks in the United States, roughly, let's call it. And I'm leaving aside the shadow banking system and other financial institutions. You look at banks. And this bill was focused on deregulating banks. At the time the bill was considered and passed, there were only 41 banks in the entire country with more than $50 billion in assets. All the energy, really, 90% of the energy in all of that bill was focused on deregulating 23 of those 41 banks. And what did that mean? When you're deregulated, you move not only away from regulation, you move away from transparency, accountability, and oversight. Hence, predation. Quickly, and everybody knows what it is. Frankly, it's not how they do it may be a mystery, but you just look at the bonus numbers. That's where you find out where often, not always, there's a lot of legitimate financial services being provided that support the real economy. The problem is that that is not as lucrative as the high-risk, high-leveraged, trading, non-social aspect of finance, and that's where the real money is. So you've got this massive deregulation that kind of hides risks, juices bonuses, creates leverage, and creates systemic instability that leads to both predation, it leads to the corruption of the judicial system, it leads to the corruption of the political system, it leads to the delegitimization of all of it. Because you end up with two tiers in this country where the people have got a lot of money and get away with it, and the people who don't. And that has, as Rob pointed out pretty well, social, political, cultural consequences that we're seeing in the election, among other places. And that's it.
Yeah. Thank you very much.